divided by actual bad debt losses. On the exam, total credit sales may be net sales or any available sales figure. Again, this is something they do on the exam, is they will make up a heading that isn't out of the books. But if you stop and think about it for a minute, such as if they say total credit sales, and that's the only sales figure they give you, that must be total sales. If they say net sales, you know, anything that they tell you that is a total sales figure, that's what you're going to have to use for your total credit sales when you're doing the ratio analysis. In other words, they're trying to be tricky. They're trying to say to you, well, what you're looking for exactly isn't there. So you have to find something close and use this category that's close to solve the problem. And if you can't make that leap, then you're going to miss a lot of questions. Accounts that can be managed. You have the cash account, petty cash fund, receivables, bad debts, inventory, retainage, long-term assets, prepaid assets and deferred assets, current liabilities, accounts payable, notes payable, taxes, and deferred credits. These are all categories that you can manage. And if you manage every one of them well, you can pick up a couple percentage. You can pick up a couple percent income off of it. But it takes a lot of time. So on the one hand, you can keep your business in business when other people are going broke by managing every one of these asset accounts very well. You know, if you pick up 5% on your cash assets, your receivables are all coming in on time, you're getting paid, you're buying and selling your machinery at a good pace so that you're making money on it. Same with your land. All these things can keep you in business, but they take up all your time too. When are you going to have time to do construction? So it's a trade-off. You need to know that it is important to manage all these assets. On the other hand, you're probably going to have an accountant or somebody who's going to stay on top of this for you and give you advice. Okay? So you have to balance that out. For the exam, what they want you to know, all these categories exist. They can be managed. They need to be managed. If you manage them well, they can help keep you in business. You can make 10% profit just by managing all your assets well. Property depreciation methods. On the exam, they're going to ask you about straight line depreciation for residential real estate, straight line depreciation for commercial real estate, 200% declining balance depreciation, 150% declining balance depreciation, and MASARs. MASARs, you're not going to have to calculate any of those. You're just going to have to understand it. So you're going to go to the book and look it up in their Builder's Guide to Accounting. Just understand what MASARs is all about. On the exam, typically they're going to ask you to calculate 1 or 2 straight line depreciation questions and 1 or 2 200% declining balance depreciation questions. Calculating straight line depreciation, you take 100% or 1 and you divide it by the life of the asset. This gives you a depreciation factor. For example, we have a $10,000 item, 5 years depreciation straight line. So it'd be 100 divided by 5 equals 20% a year is how much you're going to write off. So your 10,000 divided by 20% is going to give you $2,000 a year. So in straight line depreciation on your $10,000 asset for 5 years, you're going to depreciate $2,000 annually. And see, they'll ask you something like, in the 3rd year, how much is this asset worth? And so you're going to have to go down through there, calculate 2, 4, 6, 6,000 off of 10. So at the end of the 3rd year, it's going to be worth $4,000. Then you have declining balance depreciation. Asset life is a depreciation factor just as in straight line depreciation. The factor is applied to the remaining value of the asset. That's the only thing that changes between straight line depreciation and declining balance, is that you use the remaining balance from the previous year. So for example, we have a $10,000 item with a 5-year life and we're using 200% declining balance depreciation, or double declining as it's sometimes called. And what we would have is $10,000, the first year you get double. So instead of 20%, you're getting 40%. So the first year you get $4,000. Your basis or your book value then is $6,000 remaining. So at year 2, your basis starts at $6,000, not $10,000. With straight line, your basis is always your beginning amount. With declining balance, every year your new basis becomes the book value from the previous year. So in year 2, your basis will go down to $6,000. You still get 40% of that, which is $2,400 depreciation, leaves you a new book value of $3,600. Year 3, you're going to have $3,600 times your 40% gives you a depreciation factor of $1,440. You get to write off that year. Your new book value for year 4 is $2,160. So year 4, your basis becomes $2,160 times 40%, $864, gives you a new book value of $1,296. Year 5, so you get the idea. Every year in declining balance, every year your basis goes down. In straight line, your basis stays the same every year. That's where a lot of people make a mistake, and that's one thing you need to think about. Rule of thumb, this isn't going to be on the exam, but sooner is better than later, more is better than less. In depreciation, typically when you're depreciating an asset, you want to match it to your income. If you have more depreciation than you have income, you're wasting your depreciation, okay? So you want to try to match your depreciation to your income stream. But generally speaking, the sooner you can write it off, the better. Money you get today is worth more than money that you would get next year or the year after that because of the time value of money. So sooner is better than later, more is better than less. Write it off as quick as you can if you have the income to cover it. The next one is MASARS, Modified Accelerated Cost Recovery System. MASARS provides for 3, 5, 7, 10-year asset lives at a 200% declining balance. 15 and 20-year assets have 150% declining balance. Autos and trucks have a 5-year 200% declining balance. Office equipment, 5 years, 200%. Real estate, residential is 27.5 years. Commercial is 39 years, straight line only. Accounting methods. We have the percentage of completion is an accrual accounting method where the transaction is entered on the books as soon as the transaction or the agreement takes place. It doesn't wait for money to change hands. Completed contract is a cash accounting method where income and expenses are recorded when cash changes hands. But in completed contract, you're not going to record your income until you complete the job. This is mostly used on small jobs. Say you're building a sunroom for somebody, $20,000, $30,000, and you don't record your income until you finish the job. All right, that would be completed contract. When you complete the contract, you enter it on your books as income. The percentage of completion, you enter the percentage that you're complete. So if you're 20% complete on the job, you enter 20% of the income from that job. It's more accurate, it's more difficult, and you may have to go back and change your income amount. Let's say you said, well, we're 20% complete on this job, and then something goes wrong in the middle of the job, and suddenly instead of making money, you're losing money. Now you have to go back and amend your tax return and change your books and say, well, you know, we thought we were going to make $100,000 here, the job went wrong, now we've got to go back and take that money off the books. So percentage of completion is much more accurate. It requires a lot more book work. Your completed contract is a lot easier. So for small businesses, typically they would use completed contract. Your petty cash fund. A fixed amount of money is set aside for purchases that are too small for a check. The Builder's Guide to Accounting believes that a petty cash fund, a properly operated petty cash fund, is absolutely imperative for a construction business. And the system they suggest is a voucher system. And the petty cash voucher is used to track spending out of the petty cash fund. And so what they'll say is you have a petty cash fund with, they suggest $300, and anyone who takes money out of there has to sign a voucher and put it into the petty cash fund and say, I got $20 to go get some bolts or screws at Ace Hardware store. And then when they come back, they attach the receipt to the voucher slip. They like staple it to it, put it back in the box, and put the change back in there. And that's the idea, to keep everything straight. Reconciling your bank statement. You're probably going to have to do one of these on the exam. It's not really hard, but you have to know how to do it. First of all, you list the balance on your statement. Then you add checks that you've deposited that they have not cleared. It used to be a big deal that checks might not clear for 5 to 7 days. Now there's a law they're supposed to clear them with a day or two, but if the check's from out of state or anything, it still can take 5 to 7 days. So you look at your statement, you make sure that all the deposits you've made are on there. All the checks you've deposited are cleared. That's called in transit. Okay, you add those deposits. You deduct checks that you've written but that haven't been taken out of your account yet. So you look in your checkbook and you see you've written 2 or 3 more checks, but they haven't cashed. All right, so you subtract that. You add or deduct any incorrect charges, like if you had any overdraft charges, something like that. Or if they charged you for something that wasn't right, you make any corrections. And then the net of that is your reconciled bank statement. That should be the amount of money you have in your bank account. Okay, the next thing we're going to do is reconcile your checkbook. Basically the same idea. You list the balance in the checkbook. You deduct your service charges, whatever your bank charges you every month if they have a monthly charges. You deduct any bad checks, like somebody wrote you a bad check. You deduct any charges that the bank has made to you. And then the net is your reconciled checkbook amount. This should match up to your reconciled bank statement if all goes well. Okay, the next thing is markup profit. Markup profit is very important. There's an entire book written on this one subject. I think that's a bit much, but still the point is how you calculate profit can make a big difference in whether or not your business makes it. Secondly, when you're doing any sort of government contracts, they tell you which type of markup you're allowed to use. So we have markup from cost and we have markup from selling price. One method is to make the profit based on your cost to do the job. The second method is to make the profit based on the total cost of the job. So we'll do markup from cost, overhead percentage plus desired profit margin equals your percent direct cost of the job. And so then you multiply that by 1 plus your percentage, and that equals your bid. An example of this would be like you have 24% overhead, you have 18% profit, so you're going to add 42% to your actual cost to do the job. And let's say your actual cost to do this job are $54,000. You want your 42% for overhead and profit, so you multiply 54,000 times 1.42, you're going to come up with $76,680 as your bid to do the job. Now, markup from selling price is calculated based on the percentage of the end value, okay? So you have 100% minus your overhead plus your profit margin equals a multiplier. So we're doing it almost backwards from the last way. Your job cost divided by your multiplier equals your bid amount. And here's the example. You've got 100%. You remember last time we had 24% for overhead and 18% for profit. So we subtract those from 100%, that gives us 58%. 54,000 cost divided by 0.58 or 58% is going to give us a bid on this job of $93,103. If you tell somebody, I will do this job for cost plus 20% profit, depending on which way you mark up your profit, mark it up from cost or mark it up from selling price, makes a big difference. You're making 20% profit. That concludes the summary of the accounting for the Builder's Guide to Accounting. You really need to study the information in this book and know it very well. From there, you need to be able to go into the Builder's Guide to Accounting and find the references and solve the problems in the book. On the exam I give you, the trial exam, you have 100 questions. Look all those up in your Builder's Guide to Accounting, solve those problems, figure out how to solve them.